Today, Coinbase shares have another roller coaster day after going public in a major milestone for the crypto community. Plus, the big banks kicked off earnings season this week, and what a start it's been. We dive into the eye-popping record high numbers out of Wall Street. And finally, the Florida real estate market is hot, maybe too hot. Brokers are now worried about running out of houses to sell. I'm Pippa Stevens, and this is CNBC After Hours. Another major threshold crossed on Wall Street as the Dow Jones breaks above the 34,000 level for the first time in history today. And it wasn't just the Dow. The S&P 500 closed at a record high, and the Nasdaq finished in the green as well. Stocks were fueled higher by a stunning boom in retail sales. Every month, the Commerce Department reports this data, which investors watch closely as a read on the state of the American consumer. And in March, consumers spent money on goods and services, which is a good sign for the health of the economic recovery. But it's not green all across the board today. Coinbase shares dropped slightly after the company's public debut yesterday. It was a volatile first few trading sessions, but even so, the public listing is a huge deal for Coinbase and the crypto industry at large. Why? Well, we asked Kate Rooney to walk us through it.
So the Coinbase listing was seen as a huge moment for the cryptocurrency industry. People saw this as a watershed moment. There was a lot of excitement and the hype around the actual listing and what that meant symbolically for Bitcoin and cryptocurrencies. After years of criticism from Wall Street, it's now seen as a little bit more mainstream. The largest U.S. crypto exchange is now a publicly traded company, and that cannot be understated in terms of legitimizing things like Bitcoin. So in terms of measuring the performance of the listing, it depends on who you ask. So if you talk to the private investors, those who got in early, this was a great outcome for them. It was trading at one point above where it was sort of trading in secondary or private markets. This was a big liquidity event, meaning that they could sort of cash in. There's no lockup period in the direct listing. So early, whether it's employees, founders, venture capital investors could all sell on the day that the company went public. So in that sense, if they wanted to get out and take some profits, plenty of people could. So that was good for VC investors. In terms of the retail investor, it really depended on where you bought. So the price was extremely volatile yesterday. We saw it spike, and Coinbase's market cap reached more than 100 billion at one point. It sort of ended around 85 billion, and it's kind of up and down today. It's trading slightly lower. But similar to Bitcoin, this is proving to be a pretty volatile stock so far. Coinbase's valuation at whether it's $100 billion or even $85 billion is larger than a lot of the existing US exchanges. So if you think of NASDAQ, the parent company of the New York Stock Exchange, at its listing price, or even with some of those fluctuations, it has proven so far to be more valuable than a lot of those public exchanges that have been around for decades. So there's a lot of skepticism in terms of looking at Coinbase and saying, okay, their business model right now is trading. They make the majority of their money on trading fees. That's similar to what a brokerage firm does. So why are they valued like a tech company? The people that believe in Coinbase and would say that they're there as long-term investors think that it is a sign of what's to come in sort of, they call it the crypto economy or decentralized finance. So the idea here is that Coinbase is positioned to help other apps, other companies, other forms of finance, whether it's mortgages, other trading exchanges, basically go on to blockchain. And they say that Coinbase is really a first mover here. It should benefit as other parts of the economy move on to the technology that Coinbase has helped sort of give rise to, which is blockchain.
Okay, let's get to our sound check. Here's a roundup of the day's biggest action and what the top newsmakers and business leaders had to say on CNBC's airwaves.
Gartner says this year that software companies spend by large enterprises, which are the customers of most of these companies, will increase by almost 11%. That's a huge amount of growth for these companies to share.
I'm encouraged by how many people are focusing on it. I'm encouraged about the narrative. It may become a great asset class, and I do believe this could become a great asset class, cryptocurrency. I don't believe it's a substitute for currencies. I think we're going to have cryptocurrencies of dollars, cryptocurrencies of other currencies.
this is American politics today. It's as divided as anything that I've seen. As a matter of fact, I would describe politics today as chaos.
If you look in the first part of April, that growth rate continues. So that bodes well for the recovery as long as the vaccine virus track continues on, and as long as people get vaccinated and the economy is open. You're seeing, even before that happens, through March and now through the first couple weeks in April, you're seeing the growth at a 10% plus rate, which is very strong.
All right, the housing market has been red hot for about a year now as low mortgage rates, COVID lockdowns, and work from anywhere policies turned renters into homeowners and city folk into suburbanites. But another real estate theme that predated the coronavirus accelerated under pandemic conditions, and that's the wealth migration to low tax states. And it's clearly evident with just one look at the Florida real estate market. There's no state income tax there, which is a stark contrast to New York, where ultra-high earners are staring down the new highest combined tax rate in the nation. And they're ready to pay up for a mansion in sunny Florida. Prices have been rising for months, but now brokers are warning that the inventory of homes is running dangerously low and may not be able to keep up with surging demand. Robert Frank can explain.
A year after the pandemic, the Florida housing boom shows no signs of slowing. You've got record low inventories, record high prices, and sales velocity that just keeps getting faster. So just take a look at Palm Beach, for instance. There you had the average sale price now $9.5 million for a single family home in Palm Beach. That is a record. Meanwhile, there is now less than a 2-month supply. So that is a record. So theoretically, in 2 months, they will run out of mansions to sell to wealthy people who are moving to Florida. It's not just those big homes in Palm Beach. You look at South Beach in Miami, condo prices doubling just in the first quarter. You look at Wellington, Boca, Bal Harbor, all of these markets, even secondary markets in Florida like Tampa and St. Pete, seeing double-digit price increases and record low inventory. Now, the challenge that brokers have is, will they have enough houses to sell in the second and third quarter? If you look at the wealth migration to Florida, it was traditionally retirees who loved the sunshine and the golf courses, right? Now, the big three in Florida, the draws are, of course, the weather is terrific. The lifestyle is much nicer than, let's say, in New York City, where you can't have a yard and a swimming pool. But most importantly right now is taxes. And we just got a tax increase in New York State, coupled with the fact that the cap on state and local deductions continues to be just $10,000. So if you are a high earner or a high property tax payer in New York State, that is costing you. And Florida has no state income tax. So you look at a year like this year and last year, where the market gains for those who have invested are massive. Those are capital gains that you don't have to pay if you live in Florida. Plus, you enjoy all that sunshine. The big question was whether this will be a temporary move or just a few rich people that move from New York to Florida and who cares about them anyway, or whether this is something more structural where it's not just the wealthy but the affluent and younger families that are moving from New York to Florida. And what we're seeing now is evidence that this is structural, that the people that are buying in Florida right now are younger families. The price points are, let's say, $1 to $3 to $4 million apartments and homes in Florida. So not the super high end, but still expensive. And that's where the tax base of New York will really get eroded if you get the mass affluent and those younger families moving to Florida, and that becomes a structural problem for New York.
Okay, let's get to our numbers round. Today, we dive into the monster earnings the big banks have been reporting this week. These figures are truly eye-popping. So let's kick it off with 398. JP Morgan's quarterly profit soared 398% from last year to a record high of $14.3 billion. At the height of the pandemic, JP Morgan and all the other big banks set aside billions of dollars in reserves to brace for potential loan losses. 23 million Americans were unemployed last April, so banks had to prepare for people to default on their mortgages or small business loans. Here's the thing, though. Those large-scale losses never materialized. So now, JP Morgan and its fellow banks can release some of those reserves, and that cash was added to the quarterly bottom line. Next, $3.8 billion. Goldman Sachs raked in nearly $3.8 billion in revenue from investment banking alone last quarter, a record high and a 73% jump from the same quarter last year. Goldman can thank all the furious IPO activity for that, especially SPACs. Remember, SPACs are those special purpose acquisition companies, often called blank check companies on Wall Street. It's when a group of often high-profile investors raises money through the public market and then searches for an acquisition target for the next couple of years. Well, the first quarter of 2021, SPACs raised more money than they did during all of 2020. And all those deals need investment bankers, hence that record high revenue for Goldman. And finally, 13. Citigroup is closing up shop in 13 of its international consumer banking markets. The bank's new CEO, Jane Fraser, said in the earnings release that going forward, the firm will double down on wealth and will focus its non-U.S. consumer efforts in 4 locations that have high wealth concentration. That's London, Singapore, Hong Kong, and the United Arab Emirates. And when we say consumer banking, we mean the kind of banking that you and I do. It describes services like deposits, savings accounts, credit cards, and loans for individual people instead of for businesses. Fraser says Citigroup doesn't have the scale to compete in all the markets it's leaving, and that's why it's only going to play in places where she thinks the bank can make serious money. We've got so much more on the blockbuster bank earnings up on CNBC.com and on the CNBC app. That's it for After Hours. We'll be back here in our home office every Tuesday and Thursday, so be sure to catch us then.